Welcome to the deep dive. So you sent us this fascinating stack of sources on the information technology services sector. And your stock screener, well, it ignored all the usual suspects and instead gave us three completely different companies.
It really did. We've got data as of December 17th, 2025, and it points to a steady U.S. giant, a massive global titan, and what you called an absolute firecracker microcap.
That's putting it mildly.
Yeah. So our mission today really is to go beyond just the headlines and synthesize what these three companies, Cognizant, Infosys, and Megafortune, tell us about the whole spectrum of risk and reward in IT services right now. We're looking at three totally different ways to think about investing.
Exactly. We're going to break down the valuations, the news that's moving them, and the technical triggers for each one. And then for a little fun, we'll run some hypothetical paper money math. We'll start with $5,000 for each and see what the real-world impact of these moves actually looks like.
Okay, but before we jump into the numbers, we have to make a quick and very important note.
Right.
All the information we're talking about today comes directly from the financial reports and screeners you provided, and it's all for educational, informational purposes only. The paper money math is based purely on those data points. It should not be taken as any form of investment advice or recommendation. Investing has significant risk. These are just illustrations.
Got it. Okay, let's get into it, starting with the biggest U.S. company on our list.
Cognizant Technology Solutions, ticker CTSH. CTSH is really the anchor in this group. It's a major U.S. player, S&P 500 component with a pretty hefty $40.36 billion market cap. It just closed at $83.63.
And their business is kind of the backbone of the economy, right? Financial services, healthcare, media.
It is. They're the stable choice here.
Stable, yeah, but it seems like they're picking up speed. The financials look rock solid. I'm seeing over $20 billion in sales, netting about $2.13 billion in income. So let's talk valuation. The PE is 19.39. How does that stack up?
So that 19.39 is already pretty reasonable for this sector.
Yeah.
But the real story, the key insight, is the forward PE.
Mm-hmm.
It drops all the way to 14.91. That difference, I mean, that's a huge vote of confidence from the market. It suggests everyone expects future earnings to seriously outpace the current price. The PEG ratio is 1.72, which also shows there's still value there.
I appreciate that breakdown. For someone listening who, maybe doesn't live and breathe these ratios, what about the balance sheet? Is it healthy?
It's a fortress. It really is. We see very, very low debt, a debt to equity of just 0.08 and just exceptional liquidity. They have a quick ratio of 2.36.
And what does that mean in simple terms?
It means they have more than double the liquid assets they need to cover all their short-term bills. It's incredibly safe at a return on equity of 14.50%. And they're managing shareholder money really well.
Okay, so that brings us to the driver, the real story here, the news and catalysts. And it is all about AI, just pure AI momentum.
100%.
They unveiled a new AI lab. They struck a big partnership with Anthropic's Claude. Analysts are just falling over themselves for this.
They are. And that AI story is translating directly into higher price targets. We saw a whole bunch of recent upgrades, ratings shifting from neutral to buy.
Yeah.
Evercore ISI even hiked their target to $100.
$100. Wow.
And they just closed the acquisition of 3Cloud. This is a company in motion. Yeah. They're buying and building.
Okay, but hang on. This is where it gets interesting. Analysts are raising targets to 100, but the technical data shows something else. We saw a lot of insider selling.
A very important point, yes.
Officers and directors selling shares all through November and December at prices from $70 up to $84. How do we square that? Is it just profit-taking, or is it a warning that the AI hype is getting ahead of reality?
It's a crucial question. For a company like CTSH, with such strong fundamentals, it's probably just routine profit-taking. But you're right, it's absolutely a caution flag for anyone looking to jump in fresh.
Because the insiders know it's had a good run.
Exactly. And you see that sentiment reflected perfectly in the technicals. The short-term momentum is just spectacular, up over 17% for the month, trading more than 13% above its 50-day moving average.
And that kind of explosive move has to be pushing it into, what, uncomfortable territory on the charts?
Precisely. This is our critical technical metric. Yeah. The 14-day Relative Strength Index, the RSI. CTSH's RSI is sitting at 78.31.
78. And 70 is the line in the sand for overbought, right?
It is. So this reading is a potential sell trigger, or at the very least, a strong warning against starting a new position right now, no matter how good the AI story sounds. The chart is screaming that it's due for a pause.
even though the average analyst target is still a bit higher at 85.76.
Correct. The technicals and the fundamentals are in a bit of a tug-of-war.
Okay, let's run the paper money math on this momentum play. We'll simulate buying in right after that strong Q3 earnings report on October 29th. We'll commit our $5,000 at that day's price of $75.18.
All right. At $75.18 share, a $5,000 investment, that gets you 66 shares. Your total initial cost would be $4,961.88.
So holding those 66 shares until the close on December 17th at $83.63.
Value of that position jumps to $5,520.58.
Not bad.
That's a paper profit of $558.70, an 11.26% return in just over 7 weeks. It's a perfect example of how strong earnings and a hot catalyst can really pay off.
Okay, now let's shift gears completely. From the U.S. anchor, we move to the profitable global giant, Infosys, ticker INFY, an Indian titan.
And INFY is much larger than CTSH. We're talking a market cap of $75.70 billion. It's an ADR on the NYSE, closed at $18.22. Now, its PE is higher at 23.13, but the story here is totally different. It's all about quality and profitability.
That's the key distinction, isn't it? The metrics scream well-managed company.
Absolutely. I mean, their profitability is significantly higher, a profit margin of 16.59%, and their capital efficiency is just phenomenal. We're talking a return on equity of 29.15%.
That's 29%.
And a return on invested capital of over 26%. To put that in context for you, that ROE means for every single dollar of equity shareholders have in the company, INFY is generating 29 cents of profit every year. These are world-class numbers.
And just like Cognizant, they're all in on AI with their Topaz Fabric platform. They're signing big deals with Metro Bank, Hanes brands. So operationally, they look perfect. Why has the stock been lagging so badly?
This is where the story gets complicated, because external forces are just dominating the narrative. Despite all that operational excellence, the stock is fighting a huge geopolitical headwind.
The H-1B visa issue.
The proposed $100,000 H-1B worker fee. Exactly. The news sources we saw indicate that if this goes through, it would hammer large Indian IT firms like Infosys. It would massively increase their cost of doing business in the U.S.
And that political uncertainty must be just crushing the valuation.
It is. It's almost certainly the main reason the stock has performed so poorly year to date. It's down almost 17%. Investors are pricing in that potential future cost, no matter how profitable they are today.
So if we look at the technicals with that in mind, the year-long performance is terrible, down over 22%, but the picture right now is actually more neutral.
Right, because the price has already been punished. The RSI is only 62.88, so it's nowhere near overbought. And the stock is trading, a good distance above its 52-week low. So this relative undervaluation, that's a potential buy trigger for a value investor.
I get it. So for a value investor, that consensus price target of $19.25 seems really doable if the political situation clears up. You're betting on a return to the average.
That's the trade. Exactly. You're betting that the company's operational strength will eventually win out over this temporary external problem. The big warning sign would be if the stock fell back towards that 52-week low, or worse, if it dropped below its 200-day moving average. That would signal a much deeper problem.
Okay, paper money time again. Let's capture that rebound. We'll simulate a buy at the absolute bottom, that 52-week low of $15.81, a true value play, same $5,000.
All right, investing $5,000 at $15.81, that would get you 316 shares, total investment, $4,995.96.
And if that patient value investor held those 316 shares until today's close of $18.22?
Their paper value climbs to $5,758.92. That's a paper profit of $762.96, a solid 15.27% return. It really shows the opportunity you can find when a great company gets hit by risks that aren't core to its business.
So we've done stability, we've done profitability under pressure, but our last stock from the screener, it's a different universe. We are leaving the rules of the market behind.
We really are.
Let's dive into the absolute chaos of microcaps with Fortune Co Ltd MGRT.
Okay, this one is the extreme, and we need to be really clear about the risks here. MGRT is Hong Kong-based. It only had its IPO in July of 2025, and it closed at $13.05. After gaining 143.93%.
In one day?
In a single day, yes.
143% gain. What are the fundamentals that could possibly support that?
There are none. Virtually none. This is a tiny microcap, a market cap of just $179 million. It lists only 11 employees. Their total sales are minuscule, just $870,000.
So the valuation ratios must be insane.
They are purely academic. A PE of over 1,100. A price-to-sales ratio of over 200. These numbers don't mean anything about value. They just reflect a massive price distortion.
Let's break down that distortion because that's the whole story here.
It all comes down to three numbers.
No.
72.73%, 0%, and 3.75 million.
Okay.
72.73% is the insider ownership. 0 is the institutional ownership. No big funds are involved. And 3.75 million is the share float, the tiny number of shares available for the public to trade.
And that's the trigger, isn't it? That incredibly low supply.
Yes. With a float that small, any rush of demand from retail traders creates this huge supply-demand imbalance. The catalyst note we saw confirms it. Retail momentum and low float dynamics. This stock isn't driven by its sales, it's driven by scarcity and hype.
The technical data is just off the charts, up almost 189% for the week. The price is trading 64% above its old 52-week high, and the relative volume is at 44.74. That means it traded over 44 times its normal volume.
And just like CTSH, the RSI is screaming overbought, but this is on another level. It's at an extreme 82.86. When you combine that with weekly volatility over 61%, I mean, MGRT is a dictionary definition of a high-risk, high-reward speculative asset.
So if the stock is pure momentum, what's the sell trigger? What's the warning sign for someone caught up in this?
The sell trigger is the momentum itself breaking down. There are no big institutions to support the price, so if the trading volume suddenly dries up, or if the price drops below a key short-term average like the SMA 20, the reversal is often violent and immediate. That 143% gain can disappear just as fast as it showed up.
All right, time for our last and most dramatic paper trade. Let's see the return from buying MGRT just before this massive surge. We'll use yesterday's closing price of $5.35 with our $5,000.
Wow, okay. A $5,000 investment at $5.35 would have bought 934 shares. Total cost, $4,996.90.
And holding those 934 shares until the close on December 17th at $13.05.
The paper value explodes to $12,189.70.
Unbelievable.
That's a paper profit of $7,192.80. A 143.97% gain in one trading day. But let's be crystal clear. This is not investing. This is pure structural gambling.
It's a perfect illustration of the different forces at play in the market.
Exactly. When you put these three IT companies side by side, you're really seeing the entire spectrum of risk. You have Cognizant with its stable AI-fueled growth. You have Infosys with its world-class management fighting these external political storms. And then you have Mega Fortune, which is just pure explosive retail speculation.
And this deep dive really proves that being well-informed isn't just about knowing what the numbers are, but understanding why they're moving.
Right.
Whether it's a new AI lab, a new visa fee, or just the simple math of a tiny share float.
Absolutely. And this leaves us with a really important challenge for you to think about, a final provocative thought.
Go for it.
CTSH's stock is technically overbought. Its RSI is 78.31. But at the same time, it has fantastic fundamental news, and analysts are upgrading it to $100. So when you're deciding what to do in the future, which do you prioritize? Do you follow the positive financial narrative betting on the story? Or do you listen to the technical signal warning of pullback betting on the chart? That conflict right there between the fundamentals and the technicals, that's the very essence of market complexity.